The show is a proud member of the Retirement Podcast Network. Welcome to the show dedicated to helping you not just survive retirement, but to have the confidence because you're doing the work to really lean in and rock it. Day after Election Day, hopefully we are all at peace and can get on with building a great country. Continue that journey. Today on the show, we are going to begin to explore year-end action items from an optimization perspective. We're going to talk about tax loss harvesting today with Erin Coe, a planner on our team. She's awesome. Her first time on the show. In addition to that, we're going to answer some of your questions. Tomorrow, we are going to have a live event online about should you do a Roth conversion or not? How do you think through that in an organized way? If you're listening to this on the day of the release, Wednesday, you can go to livewithroger.com or even Thursday, because it's Thursday night we're going to do this. If you can't make it live, but you do want to have access to it, sign up for our 6-Shot Saturday email. You can do that at rogerwhitney.com or 6shotsaturday.com. We'll send a replay of it. In addition to talking about Roth conversions, tomorrow we are opening enrollment to the Rock Retirement Club, our last open enrollment for this year, and also the last time it's going to be offered at this cost. It's going to go up in 2025. In the Rock Retirement Club, we've organized all of the resources, the financial planning tools, the education, and the worksheets for you to be able to build your retirement plan of record following the agile process. In addition to that, we put together a group of coaches and some professionals to have a safe place for you to ask questions and empower you to rock retirement. So you can check all that out at rockretirementclub.com. With that said, let's get on with tax loss harvesting. So now that we're into tax season, we're going to do a primer on tax loss harvesting. And to assist me in this is Erin Coe, a EA, which is enrolled agent, which means she's a tax geek, and she just recently completed all of your CFP curriculum. How long ago did you do that?
That was actually completed in 2021.
Oh, so it's been a while.
So
okay.
It's been a while working on those experience hours.
Yeah, so how does that work nowadays, experience hours? You passed everything, but you can't use the marks.
Can't use the marks until you get all the experience hours in, and there's 2 separate paths for that. One's an apprenticeship, and one is just the regular path. So it's either 4,000 hours or 6,000.
Okay. So there's a pretty high bar to be able to use the CFP marks. That's pretty cool.
There is, yeah.
I like that. And you have recently started on our advisory firm and have been a rock star. So thank you. Although you can't take that nickname. That's Nicole's nickname.
I can, but I haven't been given a new nickname.
Yeah, we have, they have to be, the nicknames just come to us. We can't figure it out. We have Kim Possible.
It will be an organic process.
Yeah, Troy is T-Dog. Tracy is Mrs. T. I'm whatever. So we'll figure out your nickname at some point. But you're going to help guide us through tax loss harvesting, which is one of those year-end items that should be looked at from a tax management perspective.
Certainly, yes.
Yeah. So what exactly we're going to build this from the first step. So what exactly is tax loss harvesting?
So tax loss harvesting is the act of intentionally selling capital assets at a loss in an effort to reduce your current or future tax burden. So first of all, you need to know what a capital asset is. It's property that you own. You use it for investments in this case. It would not be personal property. So we're not talking about your house or your couch or your car or anything like that. It could be collectibles like baseball cards, stamps. But today we're just going to talk about stocks, ETFs, things that would be in your portfolio.
Okay, just as a side question. So I have these 2 lots in Colorado that I purchased and initially had the intent of building. When I sell one or both of them, will I have a capital gain or loss on those?
Was it held as an investment?
How is that defined? You could argue yes or no. Now that I'm not building, I guess they are.
You could ask your auditor
My auditor? Do I have an
from the
auditor?
IRS.
So it's up to me to present it as this is an investment vehicle and I lost money in it. And then they would have to argue, no, that was personal use. So that's a area of negotiation if it ever came up and if you got audited.
Correct.
Okay. So let's define what a loss is. So give me a basic example.
So an example would be you buy ABC stock for $10. That's your basis in it. That's what you paid for it. And you sell it for $8 after it's lost some money. You have a $2 capital loss on that stock.
Per share. So in practical purposes, it's been great markets the last couple of years from an equity standpoint. But when you look at your portfolio, if you have some fixed income investments, whether an individual bond or a bond fund, you likely have some losses on the books, depending on how long you own them, because bond prices have come down over the last year and a half. So that would be an example of that, right?
Yes.
And so if I have a loss on, let's say, ABC bond fund, let's say a loss of $10,000, if I sell it, even though I want to have a long-term position, if I sell it, I'm going to realize a $10,000 loss. How does that help me, or how does that impact taxes?
So it can impact them in several ways. So the first way would be if you were to, say, harvest $10,000 worth of gains that year, they would net each other out. So you would not have any capital gains that year because they'd be offset by your losses. So you'd be getting money in your pocket, but you wouldn't actually be taxed on that. The second way is, say you take a $10,000 loss and you have $5,000 in gains. Now you've got $3,000 or $5,000 left over. $3,000 of that can be used to offset other income.
Okay. Whatever happens to the other $2,000.
So the other two gets carried forward to the next year. So the next year, if you have capital gains, you can use that again. Or if you don't have capital gains, you can deduct that against other types of losses or other types of income.
Okay. So if I sell lot number 1, that's an investment, for $1 million profit, that's all going to get taxed at long term. The difference will get taxed at capital gains. But if I sell lot 2 at $1 million loss, they will offset each other. And I'll have net no capital gain because they offset each other.
Correct. They will offset each other.
So that's unlimited on the upside of offsetting. But you can only deduct up to $3,000 per year just off of any income after you've done that reconciliation.
Right. Against ordinary income, usually.
Okay. And then that loss that I can't use in a given year because of that $3,000 cap can be rolled over for next year.
Can be rolled over for next year. And if you don't use it all, it can be rolled over again and again and again until you die. It cannot be passed on to your spouse or heirs or even to your estate.
Even to your estate, because everything has a stepped up in basis as a...
Yep. It dies with you.
So why are we even talking about this? What are we trying to do from a tax perspective?
Well, your basic intent anytime you do this is to reduce your taxable income, which reduces your tax liability. Your strategy might be different. Your strategy could be to reduce your income this year, and that's it. It could be to generate a $3,000 loss this year, or it could be to generate large losses that you can carry forward for many years to come. It can also have kind of side effects when you do this. By reducing your taxable income, you lowering your overall capital gains rates. You could reduce or eliminate NIT, which is net investment income tax.
That's one of those sneaky taxes for higher income earners that we don't even think about, but it's, 3.8%?
3.8%, yeah.
That's a lot.
Yeah, it adds up, yeah.
Okay.
You can also reduce the amount of your Social Security benefits that are subject to taxation because that increases with income. You might reduce or eliminate IRMA surcharges and stay under one of those hurdles. You could possibly increase your eligibility for or the amount of your premium tax credit if you use ACA subsidies. And, you could increase your eligibility for other tax credits that are subject to income phase outs.
It's a lever to have to help control these downstream impacts to all these other things that get calculated in adjusted gross income.
Correct. Yeah, exactly.
Okay. So how do you gauge the intent of this, or the impact of this, actually, I mean?
So the impact is, first of all, did your strategy meet your intent? Like, did you actually offset all of your capital gains, or did you actually create a $3,000 loss or a $3,000 deduction against other ordinary income? Did you actually create this carry forward? Or you could check and see if you got any of those ancillary benefits. And the way you want to do that is you can either create a spreadsheet and put those numbers together yourself. There are some online calculators out there that will calculate some of this information for you, or you can use a website like Dinkytown to kind of create a fake tax return and then make another copy of it showing those losses, and it'll show you the difference.
What was the name of this website?
Dinkytown.
Dinky, Dinkytown?
Town.
Okay.
Yes, you don't know Dinkytown?
I'm familiar with it, but I always laugh when I hear the name. And so what is that? And we'll have
everybody's going on down to Dinkytown.
Okay. That's their tagline, obviously. And what does it do?
So Dinkytown lets you play with a bunch of different tax scenarios and see what kind of impact it would have.
Okay. We'll have a link to that in Six Shot Saturday. And I'm assuming if you're using a TurboTax, you can also play with, well, what if I have an extra loss, or what if I don't? How often, if you're using the actual tax software like a TurboTax or other options, do they have enough releases out in order to do your taxes? Are they good on the release date? Can I use a 24 tax
So you could
version?
do a 2023 tax return right now with, say, TurboTax, and it would probably give you a pretty good idea, pretty good estimate. However, that software is not officially updated until tax season begins. And honestly, even then, releases are rolling out. If there's legislation that's late coming, if there's certain IRS rules that haven't been fully shaken out, it could be January. I've seen it in February.
So it's a little bit
for certain
that
releases. Way. Yeah. So you're not going to get perfect until it's time to do your taxes.
We're just entering in our practice doing tax estimates for year-end decisions like Roth conversions and qualified distributions and so forth. And we're using software that's relatively up to date. It's pretty good software. And Erin, you've been a big help in building the standard operating procedure for this. And there's just a lot of gaps, right? Because we don't know exactly how much interest we're going to get, or, we have instances, I think we found one the other day, didn't we, where someone was getting unemployment insurance for a period of time, and that is a factor. It's just getting good data is also hard, even if you're on top of this.
It can be. It can be really hard to get good data. And even if you know everything that's happened year to date, I mean, how many times do you see a mutual fund in December throw off a Christmas surprise? Look, suddenly we've sold a bunch of things and you have capital gains now.
Yeah. And they'll forecast it. The better companies will forecast it, but that doesn't mean it's correct still. And
right,
so it's difficult. This is...
It is difficult. So leave yourself some buffer room.
Yeah. That is the key there, is leave some buffer room to be careful. Like a good example would be on IRMA surcharges, right? Because certain surcharges like IRMA, which is the extra you'll pay for Part B and Part D for Medicare if you're above certain limits, and there's a tiered structure. It's just $1, and then you're all in on the other limit. It's not progressive, and that can have a, material impact.
That's right. Those are cliffs, and you want to avoid those cliffs at all costs. So don't get too close to the ledge on them.
Just like driving. Don't tailgate the IRMA limit.
That's right.
So I'm thinking about this. Let's go back to that bond example. So I'm assuming we have to do this in taxable accounts, not IRAs or 401ks, first off, right?
Exactly. It doesn't work in a 401k or an IRA or any of those qualified accounts, because those are treated differently for tax purposes. Those don't experience any capital gains. They just come out as income.
So I have a bond fund as part of a broader portfolio in my after-tax account. I have a, let's say, $10,000 loss on that bond fund. but it fits in my asset allocation. So I don't want to sell it because I want to have a bond allocation. But, I sure could use that $10,000 loss. So the default would be, well, it's part of my long-term portfolio, so I'm going to do nothing. But another strategy I want to talk about is I could sell that bond fund ABC and buy bond fund XYZ and capture that loss. But there are some problematic things there as well. What are my options in harvesting this loss, but not losing my allocation?
So what you're talking about there is the wash sale rule. And that means that you can't sell a capital asset and claim that loss and then repurchase it within 30 days, either way of the sale of that. So either 30 days prior, day of, 30 days after. It's a 61-day window. So although the IRS doesn't really get clear on what you can do, they've outlined things you definitely cannot do. So you cannot sell that position in one account and then go purchase it in another. So you can't sell it in your brokerage and go buy it in your IRA.
That's a wash sale. That's a wash sale.
That is a wash sale violation, exactly. Okay. You can't sell it in your account and purchase it in your spouse's account. That violates the wash sale rule. You can't sell, say it's a stock, you can't sell that stock and then go buy an option on that stock. That would be a violation. And you can't buy what they call substantially identical
So
stocks.
Define that very specifically for me.
Wouldn't it be nice if the IRS did?
So essentially is if I have a bond fund that is tied to, I call it the Lehman Aggregate Index. It's probably the Barclays, that's the bond index, the S&P 500 of bonds, we'll call it. Mm-hmm. If I sell ABC bond fund that is tied to the Lehman Aggregate Index, and I sell that, capture the loss, and I buy XYZ bond fund that's tied to the Lehman Aggregate Index, totally different fund companies or ETF providers, etc. That is a wash sale. They're substantially equal.
They may be considered substantially identical. Yes.
Identical in this
So
case.
you want to avoid those situations that are kind of walking the line. What you can do is say you're holding Coke, you want to get rid of that and buy Pepsi. That's fine. They're a totally different company. They have different management. Those are not going to be substantially identical. If you hold, say, AstraZeneca, and you want to sell that and buy a biotech ETF, those are going to move in very similar patterns, not exactly, but that would not be substantially identical. You do start to get a little questionable when you have, say, an S&P index that's offered by Vanguard, and you sell that and you go get a Schwab S&P index. You're mimicking the same thing.
That probably is going to violate.
I would think there's some gray area, which is a big reason why this is not tax advice. And you want to speak with your tax professional about that. But yeah, there's still many different ways you can hold a similar enough position in your portfolio that it's not going to drastically change things until such time as you can go back after that 30-day period and repurchase your particular fund or stock if you so choose to.
So an example of this is, let's go back to ABC bond fund that mimics the major bond index, the Barclays Aggregate or Lehman Aggregate if you're an old school guy. If you sell that and buy a high yield bond fund that is focused on the high yield segment of the market, or a short-term duration bond fund or a treasury bond fund, they likely will act 80-90% of the way there, but they're different. The problem with this, I think, Erin, isn't it, is that this is all self-reporting on the tax return and really only comes up if the IRS is asking questions, if they're going to audit you.
Correct. And this is where I have to tell you that as an EA, I am not supposed to comment on the odds of being audited or anything like that.
But it's a self-reporting thing that, like with almost all the tax information, and you walk the line to wherever you want to walk the line on these non-specific rules. But if it gets audited and they ask a question about it, you're going to have to deal with it. And
you're going to have to explain your stance.
You're going to have to explain your stance. And from a walk the line standpoint, I'm trying to use a kid analogy because they're always the best for these things like this. It's a little bit like a cockroach. So they came just innocently asking a question. And if they see a wash sale in auditing, that is S&P to S&P, just different providers, everybody knows what's going on there, right? And that's a cockroach. And when you see one cockroach, Erin, what do you normally see?
There's a lot of cockroaches.
So maybe I need to go dig deeper. And I've dealt with, as a CCO, and back in the day, our firm was audited by the SEC, and it is trying to justify everything. A lot of it is showing that you're trying to be a faithful actor within the realm. And so.
Right, exactly. And so, again, there's so many alternatives out there that can easily be argued that they would not be a violation of a wash sale rule, that I think that it's easy enough to stay away from that line. So shouldn't be a problem. But, if you do violate a wash sale rule, it's not the end of the world. It's that loss is disallowed temporarily. It gets added to the replacement holding. And then when you do eventually sell that in a non-wash sale violating kind of way, that loss will be captured in there.
Yeah. Okay. So that's the severity of it going wrong.
Correct.
What are some gotchas that we need to watch out for? Because the goal of this is, and we'll get to the end, is we should evaluate our portfolios every year to just look for the low-hanging fruit to use things as productively as possible. So, but what are the gotchas in thinking?
Well, the biggest one is that wash sale rule.
Okay.
You don't want to run afoul of that. Another one we touched on, that capital losses die with you. So if you're 102 and you're like, I'm going to go harvest a whole bunch of losses, might not be the best time if you're not going to use them all up in that year.
Well, let's hit on that one real briefly, because I encounter situations, generally it's in real estate or other private type of investments, where there'll be people that will come in with substantial loss carry forwards, in the 6, sometimes 7-figure range. And it's easy to want to bank those and use them productively, but they die with you. They go away. And essentially,
and it's so sad.
Yeah. You can tell you're a tax person when that's sad to you. But if you have $500,000 in a tax loss carry forward, that means you can go earn or realize $500,000 gain free of tax free.
Right. And you're resetting your basis. So why wouldn't you? Go ahead and use it up.
I just want to make sure we hit that point. Okay. What are some other gotchas?
That $3,000 maximum limit that we talked about that can be applied to just ordinary income, other types of income, that's $3,000 whether you're married filing jointly or single. But if you are married filing separately, it's only $1,500. So that's another one of those penalties that hits the MFS crowd. So if you are married filing separately, be cognizant of that. Another problem is those carry forwards.
Yes.
If you have a carry forward loss, every year you have to put that amount on your tax return and just kind of keep tracking it, whether you're using it or not. So say you generate a big loss, $10,000 loss in the year 2000, and 6-7 years go by, you haven't harvested any gains, you haven't touched that loss, so you haven't been putting it on your return. Maybe you switched CPAs, you forgot to tell the new guy, whatever. 2011, you have gains that you do want to count it against. Well, the IRS has come out and said, sorry, you can't. That's gone. You haven't provided the information on that. So be careful. Make sure you're always recording those. Make sure if you change CPAs that they get a copy of your last year tax return. Make sure you're filling out that tax organizer. They don't just have you do that because it's a fun activity.
It's not.
They need that information.
It's not a fun.
What? That's the most fun activity.
Well, that's why I love people like you, Erin. And so just because you put it on one tax return, you got to keep putting it on there is the point.
Yep. Okay. If you want to keep moving that forward to be able to use in future years, you have to make sure it shows up on your tax return each year.
Okay. What else? Any other gotchas we need to think about?
The mutual funds, they're not so much a gotcha as they can be a surprise at the end of year. Again, that's why we want to kind of leave ourselves buffers, things like that, and know that these are estimates. They're not written in stone until your tax return is actually done. And lastly, related party transactions for any people that thought they'd get sneaky and, oh, I'm going to sell this to my brother, my sister, my kid, my grandparent. Related party transactions are not eligible for capital loss treatment. So,
okay. Now, a couple areas where you can use this, and we'll talk about some closing behaviors, is one is obviously we're thinking about this near the end of the year, right? Because it's taxes, year-end accounting, of looking to how do we use some losses productively. Another time to think about this, and this is one that a lot of us forget, I think, Erin, is during market stresses, right? And a good example would have been the COVID bear market, which is a very, very quick bear market in hindsight, right? It happened in a month or so, and it was drastic. And we were relatively on the ball during that. In the only selling we did during that COVID bear market, which happened, I believe, in March, April, right, was to actively harvest losses and purchase other non-substantially equal assets in March, just simply to book the losses. So when you're under in a market stressor, could be just the general stock market, but it could be the fixed income market. It could be any asset. So I think those are the two big opportunities, year end, and when things are really stressful in the markets, meaning they're going down substantially very quickly, that's a time that, maybe I make some lemonade, still maintain roughly my position, but within enough margin that you're not worried about the IRS, and just book the loss, because then you can use those in later times.
That's right. Tax loss harvesting is not just a December activity. It is a year-round sport. When you see a big pullback like that, if it affects your portfolio, consider harvesting those losses. If you have certain holdings that have just turned to dogs and you just don't even want to keep them, harvest those losses. If you want, some people even set up like a set parameter. They say, if I have any holdings that drop 10% or more, pick whatever number, I'm going to harvest losses. Just don't let your emotions drive the decision. Make sure that you have a well thought out plan for when you're going to do this and why you're doing it.
Yes. And there's a lot more opportunities, I think, with individual stocks.
For sure.
Because, Intel, I'll use Berkshire Hathaway. When Warren dies, that stock will go down, right? And if you're a believer in Berkshire Hathaway, regardless of Warren or past Warren, you could sell it, reset your basis lower, buy it back, or buy something relatively similar. But it's a productive thing to have. This was a great detailed discussion, Erin. I love that you're on our team, and I love that you love taxes.
Well, I love that you invited me on to talk about them. Thanks, Roger.
Now it's time to answer some of your questions. If you have a question for the show, go to askroger.me. Our first question comes from Greg, related to an optimization question for his older relative. So here's it. His older relative is 77, has $2 million in pre-tax IRA type accounts, does not have and has never had a Roth account. So Greg's question is, if he were to start a Roth account today via a Roth conversion, would he be subject to the 5-year rule? He's trying to figure out if converting some of his IRA to a Roth is a good idea at his age. All right, Greg, so let's think through this. First off, whatever he converts is going to be taxed as ordinary income. Realize that. He can't use his RMDs to be part of the conversion. So he's already taking required minimum distributions. He would have to take those distributions and then choose to convert some pre-tax assets in addition to the RMD. And then next year his RMD would likely be lower because he would have lower amounts in the pre-tax assets. So understand that. At his age, he meets one of the two requirements of what we call the golden rule, which is, number one, he is over 59 and a half. He hits that. He's 77. But he doesn't hit the second part of it. He's not had at least $1 in a Roth IRA ever, or for at least 5 years. So he doesn't meet that part of the rule, which means if he were to convert, let's say $100,000, He would pay tax on that $100,000 in the year that he did it. And then that $100,000 would start the clock on the 5-year rule. And he would have to wait at least 5 years to do a qualified distribution from his Roth account. So what does that mean? It doesn't sound like he really needs to draw money from the Roth account. So that's a good thing. Who cares? It's 5 years. It's really for legacy. But what if he did want to draw money from the Roth account prior to 5 years? How would that work? Well, if he were to take, let's say, $50,000 out of his Roth IRA after he converted $100,000 prior to the 5-year rule, he's not going to have any tax and penalty because it's less than what he converted initially. So you can always take the money you put in out. Once you exceed your contributions or conversions, then the 5-year rule starts to apply in terms of either the early withdrawal penalty, which he's not going to hit, or taxes on the growth. So worst case scenario here, Greg, is that he converts $100,000, he pays the tax on that, and then if he takes out more than the conversion within the first 5 years, there's going to be some tax implications as a result of that. So in the situation that he's in, you have to, well, will he be doing that? Will he actually be taking money out? Because you got to hit that 5-year clock in order to take out any of the earnings or growth on the conversion. But it's calculated on a first in, first out. So they're assuming the first money's coming out of the contribution or the conversion in this case, which is not going to have any tax consequence. Now, here we are towards the end of the year as we're thinking about Roth conversions, Greg. So if he were to do a Roth conversion in 2024, the 5-year clock starts January 1st of this year, even though we're in November. So because it's done on a calendar year basis. So if he does the conversion before the end of the year, the 5-year clock actually started January 1st of this year. Some things to consider as you're doing this, Greg, with your relative is, one, by doing a conversion, is it going to impact IRMA, the Medicare surcharge for 2024? IRMA surcharges start if he's single, if he makes over $103,000 as a single filer or over $206,001 as a joint filer if he's still married. And these IRMA levels are cliffs. So if he had, let's assume he had zero income, if he converted $300,000, you would calculate the modified adjusted gross income, and that may kick him up into an IRMA bracket, meaning he'll pay more for Medicare Part B and D potentially. So we'll include the 2024 important numbers worksheet that has all of these brackets and the tax brackets and the capital gains brackets, et cetera, in our 6-Shot Saturday email. That probably should go. In fact, Nicole's listening to this. She drafts the 6-Shot Saturday and writes it. So Nicole, let's include the end of year worksheet and the important number worksheet as links in all of our 6-Shot Saturdays this month. So that way people can have access to this quickly as we talk about questions. So Greg, understand that you could have second order consequences of IRMA and different tax brackets that he might go up into. Ultimately, the question, Greg, comes down to what is the intent of doing a Roth conversion? This is a little bit about what we're going to talk about tomorrow, so maybe you watch this replay. What is his intent for this? Because we're a little late in the game, and is this for his heirs? Is this for him to reduce future RMDs because he's worried about tax rates? The better you can define what the intent is for this, the better that you'll get to a solution. And perhaps you watch the replay for tomorrow, and that will give you a more fleshed out version of how to think through this logically. Our next question comes from Stanley related to a MYGA, which is a multi-year guaranteed annuity that were pretty popular as a tactical step when interest rates were extremely low, and now they're starting to come due. So Stanley says, my wife is 75, has a taxable MYGA, multi-year guaranteed annuity, fixed annuity, let's just call it that. started long ago as a deferred income annuity, which has a basis of $36,000, an estimated end value of $50,000. And this is maturing. So these work a little bit like a CD in that they have a maturity date where the interest rate is guaranteed. And at maturity, you have some choices. And your choices are either to exchange this to a new annuity, whether it's a fixed annuity or any other kind of annuity, or take a distribution from it, surrender it. And in this case, in a multi-year guaranteed annuity, all of the growth is taxable because it's in a tax-deferred vehicle. That gain from $36,000 to $50,000 has been growing tax-deferred. So if they surrender this annuity, it'll become taxable income. But if they roll it into a new annuity, it will not. It'll be deferred still. We have a sizable taxable liquid asset. I got a $80,000 pension. We got our Social Security, all of our essential spending, and most of our fun and wish spending is covered by our guaranteed income sources. I have two other annuities, one in an IRA and the other in a taxable account with guaranteed lifetime benefits. We are gifting our children parts of these annuities annually and either spending or saving the rest. We don't really need the guaranteed income as you see, but I loathe simply taking the lump sum and paying taxes on it, probably at the 22% tax rate. What would you recommend? Take the lump sum payout, take some form of annuity income, or roll it over to another MYGA annuity or something else? Well, it's a great question, Stanley. I can't give you a recommended idea because I don't know you. I can't give you a recommendation. But let me summarize this. You have annuities now. You have ample income for anything that you want to do, base great life, wants, and wishes. And so this $50,000 in this annuity is excess money that you don't necessarily need. So if you were to take the money and pay tax on it in the 22% bracket, which is not a bad bracket, all of this money is going to be taxed at some point, Stanley, and that's important to remember. It's just a matter of when you decide to have it taxed. And understanding that helps reframe it a little bit, as you're not avoiding taxes if you were to roll it over into another multi-year guaranteed annuity. You're just deferring the taxes to another day. And so the question really becomes, is it better to pay the tax now, have the money, or defer the tax and either I or my heirs deal with it later? That's really the question. And some of that's around what will be the tax bracket that you or your heirs will be in when this tax is getting realized. Or is 22% good now? Because you could, option one, have the annuity surrendered, which would give you a $14,000 gain, which would be taxed at 22%, which means you'd have almost a $3,100 tax bill, which means net after taxes, you would have $46,900 in your hand that you could use to gift to your children. That may be the best use of this money. 22% isn't a bad rate, depending on what your situation looks like. This is why multi-year tax planning is important. Go down to what is the intent for this money. If you have a plan of record, this is excess capital that can either grow for the future and be given to your heirs, grow for the future for your own use, or perhaps starting to distribute to your family. I would think that surrendering it and distributing the money to your family might be a good use. You could work in some charitable giving there. That's a whole nother topic. When you get into some of these tactical questions, it starts to get very multi-factor. So that's why it's hard to answer these black or white in a show like this, because I only have limited information on the qualitative and the quantitative side. Given what you've said, I probably would not lock in more guaranteed income. It sounds like you have enough. I would probably lean towards, just in this moment, surrendering it, paying the tax, and either investing it in after-tax assets, because that will get a step-up cost and basis, or start to distribute this to the kids in this moment, but there may be some other options that come to mind later. I guess one other one that comes to mind is you could look at exchanging this into another annuity that has some estate multiplier. Some annuities will have features where they have a death benefit that has a multiplier attached to it. That might be an interesting thing to consider. That would take some more bespoke planning to see if, okay, you put $50,000 into a new annuity, but it has a multiplier that if you were to die, it pays out 100 or whatever it is. You'd have to search to see what is available out there, but that might be an option to consider as well. Next is Jay on timing. Okay, hey Roger, my question is about the pie or bucket approach. So we put 5 years worth of savings into our first pie slice that we have in safe vehicles like CDs. Check. I take it that as you spend it down, you replenish it from the next slice for funds needed more than 5 years. And that's going to come from investments in bonds and equities, etc. Do you suspend moving funds from the growth or upside bucket if there's a market downturn? And if so, how and when do you resume moving money from one slice to another? So essentially the question is, he has his structure in place. He has a contingency fund. He has his next 5 years of spending pre-funded in CDs. And then he has upside portfolio that's more growth oriented. And so Jay, if I understand the question correctly, okay, I can rebalance this on an annual basis. But what happens if the market is down 20% this next year? Do I refill the bucket? If so, how? And the answer is maybe, Jay. Option one is you just hard refill the bucket and you do that as part of your reallocation within your upside portfolio. So an example might be in your upside portfolio, if we have a really bad bear market, not all of the assets in that asset allocation are going to go down. Let's just assume stocks, bonds. Let's assume stocks go down and bonds stay the same. Well, now your reallocation, if it was 50-50, is not 50-50 anymore. Maybe it's 60% bonds, 40% stocks because the stocks went down in value. You're going to want to maintain a relatively close asset allocation, which means you would sell bonds and buy stocks. And that would get your upside portfolio back to the allocation that you had predetermined. Well, another way to do that is just to sell some of your bonds, not sell the stocks, and that gets you back to your 50-50 allocation. And then you peel off some of that money to pre-fund the outer years of your 5-year layer. So that's one option. Another option, Jay, is that you do not refill the 5-year income floor. That you go through a year of a bear market and you say, okay, now I have 4 years of spending. I'm going to choose not to refund it and just maintain a 4-year income floor in order to allow C's to calm. Year 2, we have another bear market. Maybe you choose not to refill and now you have a 3-year cash reserve in order to let the C's calm. That is an option that you have that is a legitimate option. And one thing that we forget, Jay, as we're making these decisions in an agile way, we're recasting what our spending actually is. So year 1 of the bear market, not only are you going to look at the value of your portfolio, you're also going to look at what your actual spending is on your base great life wants and wishes. Because when you build out that 5-year income floor, you have to decide, am I just going to pre-fund my base great life? Or am I going to add in some of the extra spice of life, like the extra trips and the extra purchases? And am I going to pre-fund that as well? Because if we get through a bear market after year 1, part of the decision is, well, what is my actual spending? And because we're in turbulent times, maybe we batten down the hatches and not do some of the extras, the extra spending, the extra travel, or we moderate some of the extra spending and extra travel, which actually would extend the income floor a little bit more because you're moderating because of bad C's. Very similar to when we have our steak salads here at the house. Shauna will buy steak. Well, with inflation, she doesn't buy filet anymore. She buys other cuts of meat because she's making a swap to try to manage expenses during a time when food inflation is particularly high. God willing, that will subside so I can have filet again and we can have filet again. So it's a little bit more dynamic than just simply tweaking the portfolio, because maybe you're just naturally spending less than what you estimated. It's always a moving target. So there's that factor in there as well. The important point of all of this exercise, Jay, is the intentionality of systematically paying attention to it, because you're also going to be testing. At the end of the bear market, you're going to be testing your feasibility again to say, how impactful was this bear market to my long-term feasibility of my current spending plan? And if it was not very impactful, then maybe you don't refill the bucket. If it was impactful, well, you have some other negotiations that you need to do on your portfolio, but also your spending side. So it's a very dynamic thing. The important part is being intentional about it and getting ahead of the curve. For some perspective, back in 2008, that vintage of Roger as a retirement planner, with clients that we work with, we went through all of 2008 with about 2 years cash reserve and navigated a 50% peak to trough drop in equity markets. We didn't just own all equities, with 2 years cash reserves, and we came out just fine. I didn't have any crash and burns. We moderated spending a little bit more than perhaps we could have had we had built bigger buffers in there. So I think, I don't know how much you have to pre-plan this, Jay. I think running the feasibility will help guide you, as well as what your life situation looks like at the time to make a decision. Now let's get to a smart sprint.
On your marks, get set.
And now we're off to a little baby step you can take in the next 7 days to not just rock retirement, but rock life. And this is going to be a tactical step in the optimization pillar. And that is to review your after-tax accounts, looking for unrealized losses. Likely it's going to be in the bond portion of your portfolio, but look at unrealized losses and start examining whether you can use those productively, either by selling them and realizing the loss, or doing a sale of the loss and buying something somewhat similar, but not too similar to the investment in order to maintain your investment position, in order to realize the loss to offset gains. See if that is something that tactically is going to help enhance your plan and provide literally a dollar payoff by saving dollars in taxes. I want to thank the team that puts all of this together: Erin and Nicole and Allison and Troy and Scott and Graham. See, when I start naming names, it's getting so big, it's hard to remember everybody. We have such an amazing team that works to put all of this together. Tracy and everybody. Thank you so much. Hope you have a wonderful day. We'll talk to you next week. The opinions voiced in this podcast are for general information only and not intended to provide specific advice or recommendations for any individual. All performance referenced is historical and does not guarantee future results. All indices are unmanaged and cannot be invested in directly. Make sure you consult your legal, tax, or financial advisor before making any decisions.